Hello everyone, my name is Kamal Manocha. I represent PMS AIF World. Last financial year has been very good for a lot of us. Investors out here made great returns and fund managers, added assets. We as a platform PMS AIF World also, added two awards. One is the best, brand impact award to PMS AIF World and Emerging Companies Award to our company Hivi Pro Capital. Testimony to the good work that we have been doing, over last 3.5 years of our journey. And today we manage and we provide investment services to 500 plus HNI, ultra HNI clients and families. And we, proudly state that we have, because we have done, great work and a lot of efforts in doing that. As a new financial year starts, we know that, this financial year is not going to be as, I would say, easy as it was the last financial year. And that is where we thought we will continue the efforts, all the more important now in this financial year, in terms of educating our clients and bringing, different and unique perspectives from some of the boutique fund managers who have higher skin in the game and who ultimately, are more like investors. And they are not only, managing money as fund managers, but they are investors themselves. So today, we have amongst us Mr. Bhavin Shah, who is the founder of Sameeksha Capital, and Naveen Chandramohan, who is the founder of ITES Capital. Both of these fund managers have a lot of things which are unique about them, as well as many similarities. I will first talk about similarities. Both manage multi-cap funds. Both have, 3 to 5 years of experience, and both are managing, multi-cap funds which are mid and small cap biased, as well as both, are managing assets which are 500 crores to 1,000 crores. Both are engineers, both are MBAs, and both have given returns which are stellar returns over last 3 to 5 years. So with so many similarities, there are a lot of things which are unique and which differentiate both of them. But more than that, we would want to understand their perspectives and views and a lot of other things with regards to their approach to managing public money, as well as their views on the equity markets. So warm welcome to both of you. I would first want to start from Bhavin, because we have had chance of hearing Naveen on our platform a couple of times before. So if Naveen, you allow me, I will first start by asking questions from Bhavin.
Of course.
So for our audience, the very first question which I would want to ask from Bhavin is that Bhavin, you have set up Sameeksha Capital, and this industry is considered to be industry of sophisticated investors. But when I go to your platform, I see your logo written in Hindi language, and I see a lot of words used on your platform which convey that you are very deep in research, very deep with regards to the data analytics, and you have a checklist of I think 140 points before you invest into a company. So I would want to understand how much skin in the game you have being a boutique fund manager, first of all. And what is so unique and differentiated approach that sets Sameeksha Capital apart from others?
Yes, thanks, Kamal, for giving this opportunity. When I set up Sameeksha Capital, one of the key objectives was that I wanted to manage my own investments, my own savings in a professional manner. And I saw this as an activity that I could continue for a very long period of time. I think longevity of some fund managers, when you look at things globally, there are some very famous fund managers who are well into their 90s and still active and managing money actively. So I thought that this could be my basically a professional activity for a very long period of time. And so I put everything I had in equities into this fund and started it. And basically, I thought that I had worked in the industry doing equity research for a very long period of time. Also, basically running an equity research, franchise for India, for global tech, for Asian tech, in different contexts. And so I thought that experience could be very useful in basically I wanted to apply whatever I learned and whatever I experienced and observed into managing money, and that has been the premise for Sameeksha. And our approach, Sameeksha, the word as suggests, we believe in looking at things carefully, thoroughly, and basically then invest, basically into the names that we pass our test. And one interesting observation I would make is that because of that process, we haven't had any big kind of flops as per se. Flop when I say the stock that would have gone down, that would have we eventually would have found to be having some serious issues, either promoter related or business related, which would have resulted in a very, very sharp erosion. We have missed out on many great opportunities this market has provided us over last 7 years. But on the other hand, we haven't had any big disaster, so to speak. And I think is reflective of the process that we follow. And this process is an evolving process. We learn from market, we learn from other investors. If we find that somebody has a very interesting way to basically select companies, we try to see if what is in it that we are not doing, and we try to improve our process. So that has been our approach all throughout. And I think, definitely, just having skin in the game, having my entire personal savings of whatever I have in equities in my PMS and AIF basically means that the benefits are for me as well from performance of the fund itself, as not just in the form of fees. And I think that is a great motivator to wake up every day and come to work, because it's like I'm working for myself in that sense. So I think that's and I think in terms of what the later part of your question, what sets us apart, I believe that the process orientation is definitely something that sets us apart, and I believe that we are particularly different in the way we look at value in a stock. We want to buy great growth companies, but we want to buy it only if they are available at the right price from which we can expect reasonable return over a 2 to 3 year horizon. And that reasonable return will vary. If it's a small company, not very liquid, our return expectation, and with the risk of the business associated with the smaller companies, our return expectations could be as high as 20% compounded over 2 to 3 years. But if it's a very large company, very stable business, very easy to buy and sell, then our return expectation would be, say, in a range of 10 to 12%. So that's how the portfolio basket is formed. So then in quantifying that return expectation and trying to stick to it, I think we are fairly differentiated, fairly different. And we are one of those PMSs who do not follow a model portfolio approach, and we can talk about that later in the conversation also if you want to. We believe that we want to give a customized experience to every investor, and we are able to do that effectively because we have developed our own software to basically manage all the portfolios. So we are able to, if a new investor joins, we want to only buy stocks which we think are available at the right price today, and over time basically build that portfolio. So that's another aspect that we are unique. And finally, I think I also want to say that we are not afraid of taking a cash call when it warrants, when it's really necessary, like it was at the beginning of COVID, for example. And that I think has helped us cushion some of the blow in the portfolio that we were taken otherwise. I think generally we are looking for growth companies that ones that we understand, ones that we believe have some strength in the business, some competitive advantage in some, and as a result, some predictability of the cash flows that they can deliver over time. And yes, we are extremely focused on cash flows. So I think some of the things that I would like to say right now, and maybe we can talk further as we go.
Sure, Bhavin. I think you have given an overview of the entire approach. I will further, come back to you asking, deeper questions to understand, more fine aspects. Now moving to Naveen. Naveen, ITES Capital, we have been doing business for a long time. We have large number of clients also in ITES Capital. So I fairly understand, but for our audience out today, and a lot of our clients are also locked in, we would want to understand from you your ideology, and particularly, the cash flow growth that you cover in your area of focus when you identify companies, and also kindly explain and discuss the name itis, why, what do you convey by that, and how much skin in the game you have and your employees have, and what has turned you to become fund manager with a 15 years of experience, and especially coming from a company which underwent bankruptcy, and you were part of that company. So over to you.
Thanks, Kamal. Thanks for having me in this forum. And you've put 15 questions into one, so I'll try and do justice to all of them as much as possible. So I think the important thing for most investors to understand is EPS growth is not the same as cash flow growth, and especially in our country, right? Because a lot of numbers in what you report in a P&L statement and a balance sheet statement can get manipulated. Whereas the hardest thing to manipulate has always been cash flows. And more importantly, just because you get cash flows, it doesn't mean it's again a good company, right? The most important thing that an investor wants the promoter or the management to be doing is to reinvest the cash flows. Because if you don't do that, the concept of incremental returns doesn't come. Because cash flows is what you have today. What you're investing in a business is for tomorrow. And just because you have cash flows today doesn't mean you're investing in a good business. You also need to reinvest that capital for tomorrow, as a result of which very few promoters and very few managements do that well. Right? So for us, it's always been, our framework has been very simple. Look for businesses which generate cash flows, because inherently you tend to buy businesses which are gaining market share as a result of that. Look for managements which are incrementally investing it north of 20%, and do not pay up to own such businesses, right? That's it. There is nothing more to investing. I always say that I think 99% of the investors you come across have the brains to invest, but only 0.5% of the people have the stomach to invest. Because every time you talk, there is always an issue of what if, right? And that's why investing is hard. Investing is not hard from a quantitative aspect. Investing is always hard from a qualitative aspect. Right. So for us, that's the value proposition that we bring to the table. We are growth investors. We care about future growth. And every time people look at how our portfolio is, I think it's been a concentrated multi-cap portfolio, and that's the way we think about scaling it as well. Now, in terms of what, the company that you were talking about, Kamal, was Lehman Brothers. I was one of the investment analysts at Lehman Brothers when we went bankrupt, and I cannot forget that, because end of the day, to be honest, you think you understand risk when you do your MBA, you finish your finance with a gold medalist, you have no clue what risk is. Only when you go through a bankruptcy do you really understand what risk is, right? And it will take me at least 6 to 8 hours for me to talk you through that event. But to be honest, who I am today in terms of how I think about risk was shaped around that event, right? So I would not sacrifice that event even if I had any other way. So I was a fund manager for 7.5 years prior to setting up ITIS, and I felt I wanted to build a long-lasting franchise in India where the fund manager and the owner are the same for the next 30, 40 years. And obviously done fairly well as a fund manager when I was managing money outside India, investing in India. But I felt that I wanted to do it in a certain way that appealed to me by running a concentrated single strategy fund, which you cannot do it outside that way in as you scale it up, right? Because I was managing around $400 million back then. So it was a process of building it ground up. The concept of skin in the game is very simple, right? End of the day, this is a strategy that works across long cycles. So why would you look for any other way of deploying your own capital? And why should employees invest in the same fund? That's the core culture of what we want to be promoting. End of the day, I want this fund to be owned by the employees of ITIS as we scale. And that's how wealth creation is. I want to build a core culture where people understand, as you build wealth, you build it over time. It's not you build it over for tomorrow. So even today at an AUM of north of 720 crores that we were talking about, I think around 9.5% of the capital is from the promoters and employees. And we would like to keep it that way as we scale as well.
Sure, Naveen, well put. So both of you have, given a good overview of, what led you to begin and start your journey, and also the approach that you are following up. And both of you, have mentioned one similar aspect, that you are wanting to invest in growth, but also are cognizant of the valuations. And this is, I think, a common aspect which every fund manager would talk about. But there are fund managers who actually today, are too much focused on growth, and they are not, worried about valuations. And in that context, because we keep doing these interactions every week, I would want to understand, from both of you one by one, from investors' perspective, there are a lot of such companies today. Let us talk about, for example, Avenue Supermart, which is available at 100 P, and which is, the story behind that. Every fund manager says that unlike anybody else who would have built a model, where they would have kind of added, stores on retail, stores on rentals. Every supermarket is kind of, buying its own property, and hence it gives them composite advantage. And in longer term, the model of not adding stores on rent, but kind of, adding own stores, and also focusing on business where you are trying to be a low cost provider of products and services, is the game changer, and it is the Walmart of tomorrow. And hence, any valuation is acceptable, and that is where it is perennially being assumed that the growth rate will be upwards of 25%, and P is so high. Now, in next 3 to 5 years, and this is one example. There are many companies out here, where there are such stories for, perceiving those stocks to be available at 100 plus PE and accepting them. I do not know whether you have such stocks in your portfolio or not. But before that, I would want you to explain what is your perspective when you do, growth investing in our cognition of valuations with regards to such companies. So you can start. Anybody can start. We can start from Bhavin.
So you want me to start, Kamal?
Sure, Naveen, you can start. Yeah.
Oh, sure, sorry. So, Kamal, I think Avenue Supermarts is a best-in-class business, right? There is absolutely no doubt in my mind it will compound wealth, even at these valuations. I think we don't own the company. That doesn't mean an investor should not own the company, right? I think you have like you said, you have a standing example of a company like a Walmart that you classified Avenue Supermarts into, in order for people to study history and look at scale. The way I think about, let's say, because you named Avenue Supermarts, is end of the day, there is no retail franchise in India with a zero net debt company, right? And today, and many people have come and gone. Most of them have filed for bankruptcy because of the debt that they actually take on. The important thing for people to understand when you look at valuations is not just look at PE, right? PE is a metric that gives you a reference. And Kamal, I've spoken to you multiple times about Nika. And we own Nika in the interest of full disclosure. And we've had multiple conversations around why I think Nika is not expensive at all. Right now, if you take the earnings of Nika today and multiply it by a multiple, it sounds obscene. But people have to first understand what is the business model of the company that we are talking about. If it is Avenue Supermarts, it is a retail company along with a real estate company into one, right? So end of the day, Radhakrishnan Damani basically in 2003 made this statement that people forget. I cannot sell onions and tomatoes at 18 rupees per kilo when I have to pay a rent of 150 rupees per square feet. That in itself summarizes his business model, right? So people will come and go. People forget that when Walmart was scaling up, there was a company called Kmart, which was actually much bigger, but had to file for bankruptcy, right? So end of the day, it is about certain unique businesses where there is no competition. So when there is no competition on the supply side and the promoter is allocating capital significantly well, then you will have multiples when you project it from the past that will look expensive. So if an investor wants to look at such businesses, how should they look at, from what kind of a framework? I will always say, rather than looking at a business from the upside, turn it around and look at the business from the downside. What do I mean by that? Let's project a scenario where things go wrong, right? What is the projection of growth rate that you project in a bear case scenario if things go wrong? Look at projecting those cash flows over the next 5 to 6 years. Talk about how those cash flows are going to evolve. And on that, if you want to talk about a multiple, see whether it is expensive or cheap. That will give you a sense of how much of downside you are protected for when things go wrong, rather than saying, I want to make 2x and 3x on this business. Right? So for us, equity management is always around risk management on the downside rather than maximizing risk on the upside. And when you think of it that way, you will understand businesses slightly better from what happens when things go wrong versus what can happen when things go right. So that's how I would ask investors to think about it rather than purely saying this is from a multiple of 100 and this is from a multiple of 150, so I'll not invest in this business. Right? That kind of defeats the purpose of first failing to understand what the business is. I'll give you a simple real estate analogy before I wind up, right? So let's say I'm from Chennai, Kamal. One of the most expensive areas in Chennai, right, is an area called Boat Club. The per square feet price on Boat Club is 30,000 rupees per square feet. Now, if someone from Chennai looks at, let's say, Nariman Point and says 1 lakh per square feet, how the hell can someone pay that? It makes no sense, right? Because you're just looking at the price and reacting to two different places. You're not looking at the history, the evolution of the two cities, the spending power of how the two cities have grown before coming at what the price is. And that is what I would ask investors to look at. First, understand the supply demand dynamics. What makes retail, for example, tick if it is Avenue Supermarts, or beauty and products tick if it is Nykaa? What is the capital allocation that the promoter is reinvesting the capital into? Are they doing it through debt or are they doing it through internal accruals? Project the downside around things going wrong and then make a call on whether it is expensive or cheap.
Sure, Naveen. So before Bhavin starts, I agree with whatever Naveen has said, but to kind of make the question more, I would say, next level before Bhavin starts, I would just try to give another aspect to the question. That today my understanding is that if I sell my house for 5 crore, or and invest that money into equities, that will give me much more returns over next say 10 years than I living in this house, right? And in that context, I am saying the rental yield of even a 5 crore house is only 1%. I can buy the same house at a 5 lakh rupee rent per annum. Why would Avenue Supermart, rather than going in a rent oriented model, invest money in real estate, and we as fund managers treat it as a composite business advantage? So this is another I would say doubt I have in my mind, and hence over to you, Bhavin. You can address your full answer to how do you see value in growth, and what is your I would say approach when you see such businesses available at high valuations, and particularly you can explain your understanding of retail businesses like Avenue Supermarket.
So we are open to looking at companies which trade at high valuation, but what we want to do is at least whatever is our understanding, which will be derived based on listening to the company, their story, their strategy, and observing similar businesses, how they have evolved in other places. We talk about, in context of Avenue Supermarket, obviously we talked about, the Walmarts of the world, but there could be other examples as well in developing countries as well. So we like to look at how those have evolved, how have their matrices improved or evolved over time, and then we put that in the context of India. That today we are at approximately 2,000, slightly more than $2,000 per GDP per capita, and looking at the demographic story and looking at the potential for the growth. If it might take another 25 years or so for us to get to something like $10,000 per capita, which is where China was, just say a year or two back. And one thing I observe is that many countries do see a significant slowdown in growth rates after that. Also, demographic wise, also we start to see decline in working age population in India sometime somewhere around that time. So we try to capture that entire period and then try to fit a particular business in that context, using the parallels in other countries. And after doing that, and if Avenue Supermarket is a market leader, we might assume that because it's such a strong business, it will remain market leader. And we'll try to project what free cash flows they can generate over that entire period, and then obviously after that maybe some sort of a stable growth. And after doing all that, if the value is such that it doesn't suggest material returns from our investment, then we won't invest. So we do that for every investment that we like to evaluate. And I think the chances are that when P multiples are so high, unless the near-term numbers are suppressed for some one-off factors, we are unlikely to invest in such names. Very rarely we come across companies trading at absolute very high P multiples that still make sense to us from a fundamental standpoint. And just to I think in the context of your question, see what I understand from when I look at the strategy of Avenue Supermarket with respect to owning real estate, I think what they are doing, and I think as Naveen pointed out, they are kind of two companies in one. They are also a real estate company, and they are a very smart real estate company. They tend to buy assets which are in areas which are not at a premium. So I think they kind of change the profile of that area by putting a store. And so they probably get deals at a very, very attractive prices. And I think so for them, that while it is investment, why one could argue that they should not be doing that. I think their alternative may be that they won't be able to get such a good deal if they don't actually own that store. And I think probably they look at the investments made in the store also to give them a lot longer value if they own the store, as opposed to having a rental situation where there are built-in escalation clauses and so on. So I think it might the way they are doing it, it might actually make sense to them in that context.
Sure, Naveen, would you like to add further to this, or should we move to the next question?
No, I mean, I think we should not focus on only one business, but considering you just raised a point around the fact that why can't they rent? Yeah. So you've seen every retailer follow. So what are the two models coming? There are two models in the retailing business. One is I go into an area which is not very popular. I buy the asset cheap. I scale and create demand, because what do I bring as a value proposition to the customer? Like Costco, they basically say the one thing that you will get at Avenue Supermart is the cheapest price. When you bring that kind of value proposition, that is an unbeatable value proposition, not just in India, globally, right? People will go for the cheapest price at scale, right? And that's what they bring. And then effectively they create the asset value over time. The other model is go into the most prime real estate, lease it out, take it on through higher debt, because that's what you are doing, because you don't generate internal cash flows. You don't do it on the cheapest model, because you're going into the likes of Bandra and Nariman Point, Hoscos in Delhi and the prime areas. And then you look at where the balance sheet gets inflated. And there are multiple companies in the retail industry in India that have done that and have filed for bankruptcy, right? So, one model works, one doesn't work. But people still go to the one that doesn't work, because that's what is they want the brand, they want the hype. But unfortunately, there's only one thing that works, that is time tested, right? So what I would say is history teaches you a lot. If you learn from history, you can scale things up. If you're looking for the next new thing or the next fad, that can result in some amount of disasters. That's all I would say.
Right. This moves me to the next relevant question in the same regards. So we have really talked about the execution capability of a promoter, and that kind of how important is that aspect, and what is it that you as fund managers looking for beyond, you can say, balance sheet? in terms of understanding whether that business is an investable business for your portfolio, for your approach. And if you are owning an existing business, how does it become a business for an exit from your portfolio? What are those signals, which are kind of there? Are these signals purely based on numbers? Because numbers, will only be known after an event has happened, right? That is where I am wanting to understand, are they only mathematical, or there are numbers beyond balance sheets that you guys follow? Starting from you, Naveen.
So to start off, Kamal, I mean, I set up ITIS with the vision that investors need to invest in the fund manager, which means people are the most important thing to understand the business, which means that's the same value proposition I bring to the table when I study a business. To me, it's about the management, the promoter, and their execution track record. So people are extremely important around what I look for. Numbers, I always say, is only 10% of the story. People define businesses over time because end of the day, they define the culture, they define the strategy, and they define the execution and the capital allocation at the top. Right? So it's extremely important for me to understand who's the promoter and who's the management, and more importantly, what is the track record if we're talking about an external CEO who's come in to run the firm. Now, when you speak about numbers, I think numbers paint a picture because numbers don't lie beyond the point. But then the fact is, how do you complete that story? You complete that story because if there is a company which is growing its market share in an industry which is either contracting or other players are not able to, that's the number part of it. The question as analysts, as for us, is why are they doing it? Now, when you go and talk to the management, every management will tell you they are the best, right? No management will tell you we are bad. So we prefer not talking to the management about it. We prefer talking to the ecosystem around the management around it. What do I mean by that? So if you are evaluating a fund manager, I say don't talk to the fund manager beyond the point. Talk to the fund manager's partners. Talk to their distributors. Talk to their investors. Has the fund manager stayed consistent over time? It's the same way for the management too. We talk to the distributors of the company. We talk to the suppliers of the company, the retailers of the company. We also go to the extent of talking to some of the ex-senior management who may have left the firm to understand the culture that they left behind. And we want to understand what the management is saying in the conference calls or the calls that they do with us aligns with what they are executing on the ground. In most of the cases that you will find, the numbers and the story will align. It's very rare that you find that the numbers on the balance sheet will tell you it's growing, but the people on the ground are abusing the company. It generally doesn't happen, right? So that consistency is what we look for in a business around when we want to be owning it. And the last part around exit, Kamal, is I laid out the three parameters around how we think about investing. When any of these parameters fail, we as analysts question ourselves within the team, why should we be owning this business? Be it in terms of free cash flow growth stalling, be it in terms of return on incremental capital stalling, which generally happens when the management says they want to invest in some unrelated businesses because they want to diversify, quote unquote, which is never a good thing for us at least. And third is finally, when the valuations become over the top. The market also plays narratives, and there are some really strong narratives playing out where certain things are getting overblown. So then there becomes an opportunity cost of holding such a business in our portfolio, and that's when we start thinking about trimming or exiting the position. So it's the same three parameters that we care about for an entry that actually guides our exit as well.
Right, Naveen. Over to you, Bhavin. Want to understand from you what is your approach to identifying a business becoming an investable business in your portfolio, and how do you decide on exit?
Right. So I think the definite. I mean, I think Naveen talked a lot about importance of investing in people, and I totally agree with that. I think the capability of management, as kind of evaluated based on their past track record. If in the same company or if the company happens to have hired a new CEO, for example, in a different company. But I think it has to go beyond the CEO. I think in many cases one has to also look at the team below the top management level, team below the promoter level, how how good is it? Is that if it's a promoter-led company, are they basically hiring good people, giving them good incentive to perform, and so all those things are important. We also look at what the company has talked about in the past, and how is it turned out, and is it it could be reflective of either the environment in which that company operates. In other words, it's a difficult industry to operate, or it could be a reflective of their own capability. But either way, it is very important. Obviously, we want to be in a business which is run by capable promoters or capable management, and in an industry which is generally a good industry to invest. I think both are important. So we try to really gauge that when we look at the basically the past track record of the company. And clearly, growth opportunity is extremely important, because if we invest in something which doesn't have material growth, then maybe there is some value. Then that value will be captured, and that would be about it. But if there is growth, then the chances are that we can own that stock for a much longer period. Now, in terms of how to decide when to exit, I think obviously if the story is not working according to what we thought, if the numbers are not coming through, if the company is talking about a different direction from what they had talked about when we invested, those are like clear reasons to think about exit. On the other hand, if it worked well for us, but when we invest, as I mentioned, we invest with a specific return objective over 2 to 3 year horizon, and we evaluate. If that objective is achieved, even sometimes it's achieved far earlier than our time frame, or if it's achieved over that time frame, then we reevaluate. What new have we learned about this business? Is it still a company that can deliver very strong, basically good growth in cash flows, which would justify owning it even from here on? What is the risk reward looking like? Our upside potential, and if it's, in other words, if you are looking at this from scratch, would we be buying this company even today? If the answer is yes, then we will continue to hold. Otherwise, we'll obviously think about exit. But we tend to not to rush into exit, because sometimes if the story has worked well for us, chances are that there are more potential positive developments that we may not have even thought about. So we try to do a more sort of careful evaluation before taking an exit call.
Sure. So now we come to the next question, which most investors generally ask as a first question. If I say it very simply, it is the views on the markets. I'm sure it is not that easy to answer this question, because at any point of time, whenever I ask this question from a fund manager, he says that I don't know. That is the right answer, I know, but still I don't want you to give such answer. Maybe the more deep question out here is that, do we see IT as a sector gaining more weights, or financial services as a sector reducing weights? Because today financial services is 40%, in Nifty 50, and IT is around 17%. And or do we see any other sector coming up from bottom, like we saw, specialty chemicals coming up in last 3 years? And likewise, today there are two top companies out of so many listed companies in India, which are part of top 100 companies worldwide, which is Reliance Industries and TCS. What are the other what is the third company which you see could be part of top 100 companies worldwide? So these are some of the final aspects I think you guys can cover in this question, which I'm wanting to ask from you. That what are your views on markets over next, say 3 years, starting from financial year 22-23? Starting from you, Naveen.
Sure, Kamal. So I think increasingly I would urge investors to stop thinking so much around markets and start thinking around individual companies. And I think we are already in the early stages of going through such a phase. What do I mean by that, right? So the moment you start saying, what do I think about the markets? The next time there is a macro event, be it Fed delevering its balance sheet, or a new war that we are talking about, or a new oil crisis that we come across, you will exit the markets, right? So I'll just give you an example of how we think about this. So in the last, let's call it 2 years, right? We've been hit with COVID. We've been hit with the Russia-Ukraine war. So inherently, there's been a lot of macro risks that we have seen that we've been hit with. Our portfolio companies' gross profit margin has actually expanded through this over the last 2 years. Our company's incremental return on capital generated has again expanded through these last 2 years. What do I mean by that? Is our market share of the companies that we own has been expanding through this phase of uncertainty and through this phase of macro risks, right? So inherently, as long as you continue to own these businesses, your portfolios will continue to compound, right? So effectively, the moment you start saying market, then you start thinking macro, which means interest rate, liquidity, oil, factors that are beyond your control. The moment you start thinking micro, then you start thinking about pricing power, gross profit margin, sustainability of market share, redeployment of capital, which begins to go under your control. So as long as you are focused on these three metrics, I think your portfolios will do well. As long as you start thinking markets, then you are going into the area of prediction, which becomes an unknown. So as long as our philosophy is always continued to be, when you own these kind of companies, from a medium term perspective, we continue to remain optimistic. In this particular year, considering whatever Fed is doing and the fact that there is inflationary pressures, I think there are certain sectors that are going to have significant headwinds. But Kamal, I think Kamal, in some of the sectors that you said, we think they are potentially sectors that one would want to own for the long term, be it in IT or a domestic API manufacturing from a pharma sector, where you are backward integrated into your supply chain. Financial services is one sector we are underweight. It's a counter cyclical view, because any FPI or a domestic mutual fund you talk to is maximum overweight financial services today, especially in the leveraged financials. But we certainly believe that financial services, because of the inherent leverage, is more cyclical than structural. And so while we were significantly overweight into 2020 and 2021, we have trimmed our exposure to a majority of our extent, apart from the two private sector banks that we own there. So hope I've answered most of the questions around how you would structure it, Kamal.
Sure. Over to you, Bhavin. What are your views about markets in the current financial year and next 3 years?
So I think, yeah, predicting near term is always a big challenge, and I think, but I do feel that there are some factors that one has to be aware of, one has to be cognizant of. We clearly are in an environment where inflation is fairly high. I think monetary policies continue to remain fairly loose. I think we are seeing that, for example, US Fed is sort of has been behind the curve. I think, and I think one could even argue that same thing for RBI. So, to me, that is a risk, in the sense that if inflation is, kind of goes out of control, I think, and I think, when we talk to people in the market, in different industries, I think the kind of price increases that we are seeing are unheard of. So this is, for me, this is definitely an issue. I think it can certainly affect demand, and so that could affect the volume growth that companies experience. And I think if inflation eventually forces the hands of the central banks to really sharply increase rates, then obviously that will also bring a slowdown. So that, I think, that risk is definitely there from a market perspective when I think about the next 6 to 12 months. I think obviously from a longer term perspective, I think, and that is probably why the Indian market hasn't really corrected much, is that the longer term story for India, I think has only gotten better and better over last 2 to 3 years. I think we are seeing far more progress on the capacity building, for the economy. And I think the other thing that I really am, I feel like I've been pleasantly surprised by is the evolution of the Indian startup ecosystem. I think we have, and I think that goes to your question about the future sectors. I think we definitely have a potential to create some world-class companies in technology, especially around the software product companies. That is, especially in the SaaS, software as a service area. And I think that is, something that I probably would not have imagined happening, say maybe 5-7 years back. So I think, and the other thing is that when there is this capacity building that is taking place, I mean, basically the infrastructure obviously is a growth multiplier. So I think eventually it will obviously help with the economic growth and corporate earnings. And I think that's basically why one has to have a fairly positive outlook from a longer term perspective, like what you say, 3 to 4 years.
Right, Bhavin. So we come to our second last question for this discussion, and that is on a very, again, important aspect, because today the PMS industry offers more than 100 credible products which are managed by large institutions, which have been running PMS services for last 10, 15, 20 years. At the same time, many new fund managers, and boutique fund managers like you, who have high skin in the game. How should investors actually go about selecting a PMS product for themselves? And is it really that PMS product is actually a superior instrument to the old well-known structures like mutual funds? What are your views from investors' perspective when you put yourself in investors' shoes? Starting from you, Bhavin.
So I think it is, first of all, I do empathize with investors. I think it is not easy to select a PMS because number one, there are too many of them. Number two, I think it's like everyone is going to present the data that looks good for them. But I think there are some things that I would like investors to pay attention to. I think definitely look at things like compared to the strategy they are talking about, how consistent they are with respect to that strategy versus their actual portfolio. Their basic, what are the investments they've made in their business to basically create a sustainable performance. It's opposed to having kind of just benefited from a major rally in the market. See how they have done in the down markets. I mean, I think that is very important. And I think because obviously that volatility is kind of important. In India, one thing that I don't see people doing often is look at the risk-adjusted return ratios. Actually, that is quite an important. Instead of just focusing on the pure absolute performance numbers, one should also look at that, and because that I think it reflects that is an important benchmark to consider when evaluating a portfolio manager. I think one should definitely look at what kind of companies the fund manager is investing in, and whether or not these are the companies that are simply kind of benefiting from some short-term development in the market, maybe as opposed to the companies that are fundamentally sound and as likely to basically have a much longer lasting story. I would also look at the overlap of the portfolio with, say, mutual funds. If it's a kind of a very similar portfolio to some of the focused mutual funds, then I think the differentiation for performance may be limited. Opportunity to generate alpha may be limited. One thing that I definitely ask investors to look at is the fee structures, because there is no real standard in the industry. SEBI has not prescribed exactly how performance fee should be calculated. They have given an example in their regulation, but I think that example has some areas which are which can allow a PMS to charge fees in a way that is, in my view, not fair to the investors. For example, we look at cumulative hurdle rate. We apply what is called hard hurdle. I mean, we can go into these details separately. But the point is that the fee structure should be aligned with the interest of the investors, and not just the headline numbers, but the actual method of calculation. So these are some of the things that I would definitely look at. And I think obviously, if the PMS fund manager has its own skin in the game, I mean, I think is is going to be quite important in my view. And whether or not he has any side pockets, like whether or not he or she invests separately in equities apart from that fund, and how is that allocation between the fund and the separate equity portfolio, because that is also important. How aligned is he with the investors? So those are some of the things I would point out.
You're right, Bhavin. Naveen, over to you.
Sure, Kamal. So, Kamal, I think while Bhavin has clearly laid out a whole host of factors investors can look at, I think I'll just summarize and say if obviously one would want to simplify things, right? I don't know if an average investor can do this level of research. Even if they want to, they don't have the time, the inclination, or the bandwidth or the wherewithal to do all this, right? So if they work with the advisors like yourself, it will make their job easier. So first, I would always say an investor should look for an advisor to work with in order to figure out who they want to be working with. Because end of the day, advisors like yourself understand the psyche of the investor, and that's important to establish. Second thing I would say is the easy way, while returns are always there for people to see, and that's going to be the future benchmark for all of us. Always look at how did the fund manager do during bad times. And in the last 5 years, we've seen at least 3 bear markets. So it's not very hard to just get those returns during the bear markets to see what fund managers did. And don't evaluate fund managers during good times. Look at what was their process during the bad times. It's a simple way to look at who is consistent and who is not. Finally, just spend some time. I would say not. It doesn't take more than 30 minutes to understand the process of a fund manager. And is it growth? Does it align with how you think? Because if you don't believe and understand in a simplistic way what the fund manager is doing, you will not stick with the fund manager during the bad times. So it's always important to understand, do you understand the process of the fund manager, and the fund manager and the team of the fund management team open enough to talk to you, right? And to answer the last question, mutual funds and PMS or AIF, I think end of the day, for me, it's about the fund manager and the person, right? Be it a mutual fund that you pick or the PMS that you pick. Mutual funds have certain restrictions, and SEBI is tightening those restrictions over time. There are some really good fund managers in the mutual fund industry as well, who are managing a significant amount of AUM. But mutual fund has always been an access product. PMS is meant to be a product which is customized for the client. So as long as you get that customization, then you should pick the manager who gives you that. So that's how I would like to summarize it.
Sure. So coming to the last question, in trying to now, only focus on how do you see, from investors' perspective, the very first question which comes to their mind when thinking of equities and asset class is risk. We have done this, I would say, primary research with thousands of investors, and I can tell you more than 80% investors, said when we think of equity, we think of risk first, and then return. Especially at time of COVID, during March, April of 2020, we asked this question over social media from investors: what comes to your mind first when you think of equity? They said risk. They said loss of capital. Now, when I ask investors that what comes to your mind when it comes to equity, they say return. But ideally speaking, at that point of time, if the answer would have been rather than risk, if it would have been returns, then those investors would have actually made a lot of return, a lot of money. And today, maybe, the thing which should ideally come to investors' mind is risk rather than returns. So how should, investors actually, what is it that you think, should be done by a fund manager like you or an advisor like us in terms of contributing to the ecosystem so that, the industry doesn't get too many flows when markets are rising, and eventually investor is able to keep a right perspective towards risk when it comes to understanding equities and asset class. Bhavin, you bring with you 25 years of experience, and I think more than 25 years experience. I forgot to ask you another very fine aspect before answering this question. Maybe you can cover that also. You went to Ahmedabad in 1994, and you left IIM Ahmedabad in 2 months. And then, you went to University of Chicago. Maybe, quickly if you can tell us what happened, and then understanding what is your ideology of risk and answering this question from investors' perspective, how should they view risk? Will be, from a thought leader like you, it will be very good to understand.
I think first of all on that question of IIM Ahmedabad, I think I was 28. I had already worked in the industry for a few years in US before joining Ahmedabad. I was 28 years old, and everybody else was 21. And I somehow felt that I was a little bit out of place. I think the way the faculty approached the students was a bit different, in the sense that they obviously were working with a cohort of mostly fresh undergrad degree holders. And so I thought that I would probably get better value, and it would be my time will be better spent going to a university where everybody else has come with some experience. So that was primarily that. I think the concept of risk, I think you are absolutely right. I think the industry as a whole has to do a much better job, industry meaning our industry, of explaining the risk to the end investors. And I think for me, my perspective of risk, to be honest, has evolved over time. But in the sense that and I think it kind of correlates with how much money am I willing to lose. I think that is probably the most important thing one has to look at. Okay? If the investment that one makes in equity markets is obviously risky, and in a short term it can you can have a very sharp negative result. In other words, value can go down quite a bit if your entry point is incorrect. So it's a money that one doesn't need for, at least in my view, one has to think about at least 5 years. It's a money that I don't need for 5 years. That's the money that I should put in equities. Anything that I may need in less than 5 years, I should invest in safer investments, fixed income and others. Obviously, there are many sophisticated tools that are available, which advisors like you can work with the investors to kind of explain the concept of risk. But I think for me, equities is is obviously where the near-term volatility can be huge. So I will the money that I need for the next 5 years, I would not put in equities. I think if I can put it that simple, that simple way.
Sure, Naveen, I'm curious to know your answer, because I know, you had mentioned that what has shaped you today is an evolution of your experiencing the risk event in your first job. So answer from you on your perspective of risk is very, I'm looking forward to it.
Sure. No, so why did I make that statement? The reason I made that statement with Lehman Brothers is the fact that end of the day, you are living with uncertainty for tomorrow, and you are investing for tomorrow and not based on past numbers, right? I still remember September 15th, 2008 was when we went bankrupt, right? Lehman Brothers as an entity. September 12th, 2008, my boss's boss, he was on the board of Lehman. He was the head of all of Asia at that time. Lehman dollars was $4.30 back then. He came to the trading floor and he said he's $3 million of his personal money there. We should all do the same because it can't go bankrupt. And he was on the board of Lehman, right? 3 days later, we filed for bankruptcy and we all lost the entire net worth, whatever we had put in there, right? What I'm trying to tell you is no one knows. But end of the day, that event taught me around downside protection. Not equity will compound wealth, right? However, how do you ensure that investors stay with you over the next 10 years? The only way you can ensure that is take them through 3-year periods and keep minimizing the downside and the drawdown that you give them. As long as you keep minimizing the drawdown, the upside will take care of itself. Now, you spoke about 2 periods, Kamal, where 2020 investors should have thought about returns, and 2022 they should think about risk. To be honest, Kamal, for someone who's not in the financial industry, it's very difficult to say that 1 year think about risk, another year think about returns. It's confusing. the easiest thing to do is think about risk all the time, right? Think about downside all the time, because end of the day, the question is, how would you react if your capital is down 30%? If you are saying that out of my 1,000 rupees, I'm okay to put 300 rupees, which is 30% of my financial assets, into a 30% drawdown instrument, that should be your investment into equities. Then the question is the process of investing, right? What kind of companies do you invest in? Which is where cash flow growth companies and companies that have a higher return on incremental capital automatically bring down your risk. It doesn't mean your portfolio will not fall, but it will inherently bring down your risk. Investing in metals, investing in energy, investing in oil and gas, investing in PSUs are great when you look at 6-month and 1-year returns. But you know that over 3-year periods, they will diminish your capital. So as long as you understand these metrics, history will just keep rhyming over time. Nothing changes, right? So the simple things once you focus on, you will realize that investors, end of the day, it's not about saying that you want complicated jargon. No one wants to hear complicated jargon, right? People want to understand simplicity and not change their mindset depending on the market. So I would always say focus on risk first rather than focusing on returns first, which is where I keep saying, look at your drawdowns, look at your worst periods, and see if you can digest that, and that will tell you who's the right fund manager or the process for you.
Sure. I think both of you have put the perspective aptly. I would just sum it up by saying that, in my personal opinion, the easiest way for investors to accept equity as an asset class is to first of all accept risk, because risk is something which is which comes with it. One has to not focus on risk, but has to accept that, and then focus on returns with a horizon of only 500 days. One should keep a horizon of 500 days while investing in any product, which means that during that 500 days, one should not be concerned about macro environment, should not be worried about underperformance or comparing it to its benchmark or the peer group. Only after 500 days, one's, concern about its underperformance with markets or with other, companies or other products should start. If you give it first 500 days, then which means that you have accepted the risk, and after 500 days, your focus will always be in the returns. That is how I have always kind of, practically accepted the risk. Secondly, in my opinion, while we discuss with various fund managers, some fund managers follow momentum investing, some do growth investing, some do value investing. Ultimately, everything makes money. It is again the question of sticking to this strategy. So if you have accepted the risk, you have invested into the product, you stick to it and do not change it, because what happens, investors make a change at a wrong time, and that is where the experiences go bad. So if you accept risk, stick to it, have patience. Ultimately, every strategy gives you return, because every fund manager out here is wanting to deliver. But yes, the point here is that investors should invest in something which gives them comfort, because if you invest with complete understanding, then that will give you comfort, and that is how you will be able to accept that during bad times. And with that, we would sum it up. Thank you so much, Naveen. Thank you so much, Bhavin, for sparing our time here. I think, in our, I would say, hunger to learn every week, this episode has been, in the same stride. And we start this financial year with good wishes to both of you, in terms of, continuing the good work. And I will come back to you again. We are going to do a bigger things which we have plans in our mind over for this financial year 22-23. I cannot reveal them now because, they are our business secrets. But yes, thank you so much for everyone to join us today. Thank you once again.
Thank you.
Thanks a lot, Bhavin. It was a pleasure interacting with you, and thanks so much, Kamal, for having me on this.
Yes, likewise, Naveen and Kamal. Appreciate having me in this.
My pleasure.